he's going to insist that the Fed start cutting interest rates. Well, that's good for gold. Okay, so people have been piling back into precious metals over the last week because they assume that the finance thing is going to be hard to fix, and the guys in charge are not equipped temperamentally to raise interest rates high enough to protect the value of the dollar and to throttle inflation. That's not going to happen. If people develop that kind of an attitude, and then you've got foreign central banks buying gold, which puts a big tailwind behind gold, and then regular investors and the rest of the financial markets in the US decide that inflation hedges are a pretty good thing to put their clients into. Gold and silver are such thinly traded markets. Gold, there's quite a bit of gold in the world, but most of it isn't for sale. So the available gold is an extremely thinly traded market. And so you could see a lot of people trying to get in through that little door.
Investors turn to gold and silver as inflation hedges, driven by doubts about the Fed's ability to raise rates high enough to stabilize the dollar and curb inflation. Central banks also buy gold, creating strong demand in a thinly traded market. If a gold-backed monetary system emerges, estimates suggest gold could reach $10,000 per ounce. Current prices, even at $2,700 or $3,000, may seem reasonable given this potential. Short-term volatility, such as a recession, might temporarily lower gold prices, but Fed easing afterward would likely propel them higher. John Rubino is a seasoned financial analyst, author, and commentator known for his insights into global economic trends. He explains that a massive financial crisis looms due to unsustainable debt, rising inflation, and escalating interest rates, creating a doom loop of increasing costs and borrowing. This could lead to a currency reset and significant economic upheaval. However, history shows such crises also offer opportunities for wealth creation through investments like gold, silver, and strategic short positions. While the situation is dire, it presents a chance for savvy investors to profit and rebuild during the recovery. Meanwhile, John Rubino is concerned that a monetary reset may be inevitable as governments face unsustainable debt and lose control over inflation. This could involve a return to sound money, like a gold standard or blockchain-based system, limiting money creation. However, governments are unlikely to give up this power willingly. Instead, market forces may drive the change as rising interest costs and deficits erode trust in currencies. This leads to a crack-up boom where people dump fiat money for tangible assets like gold, silver, and farmland. Now, we present the clips of John Rubino's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The gigantic financial crisis that's coming because of all the debt that we've taken on and that we continue to take on is looming out there. But it's harder to think of that as something terrifying because right now we can compare it with World War III, and it's nothing compared to World War III. We've had a lot of financial crises in the history of the human race, and the civilization has survived, at least, and probably what happens this time. I mean, there are different scenarios for this to play out, but a simple, straightforward scenario would be for the debt that we've taken on so far to increase both inflation and interest rates. And rising inflation contributes to rising interest rates. That makes the interest cost on that debt even more onerous. And because that interest has to be borrowed, it makes the debt go up even faster. So we get into a doom loop, basically, where rising interest rates lead to rising debt. The chart of the US government's debt expense, it's parabolic. It's going straight up right now, which means we're going to have, $1.5 trillion of interest costs in the not too distant future per year, which means the debt has to go up by that much in addition to our increase in debt to cover baby boomer Social Security and Medicare, et cetera, et cetera. And at some point people figure out that why do you want to own the currency of somebody who's going into debt at such an accelerating rate? And then you get the financial crisis that leads to the currency reset. All of that is, it's scary, but it's also something that has happened enough times in previous human history that we kind of know how it goes. So yeah, all this stuff that is financially terrifying is coming. But there are 3 or 4 different ways to make a lot of money in the process. So it's it's almost an optimistic scenario because it's potentially that's how you get rich. That's how you become the person who saves your friends and family with all your extra capital when we're at the bottom of the cycle and rebuilding from the rubble. And if you focus on that, it's not a depressing prospect at all, or a scary prospect. It's an exciting prospect because your gold and silver is going to go way up, almost certainly. And possibly is a little trickier than just buying a bunch of gold and silver, but it's there too, So there are things that if we time it right, choose the right instruments at the right time, insane amounts of money can be made from all of this. The major governments of the world just to recognize that they're in an untenable position, and then they just do the monetary reset. They give up the power to create more money out of thin air, and they go back to something like a gold standard, or I'm not ready to call for a Bitcoin standard yet, but it might be some kind of blockchain related thing. Maybe it involves gold and silver. It could be any number of things, but the common thread is that we go back to sound money of some sort that takes away from governments the ability to just create money out of thin air and limits the money supply growth going forward. I don't think we're smart enough yet. And I think the people with the power to create money out of thin air aren't going to give it up willingly. So more likely will be the scenario where the markets just force it on governments. In other words, like I was saying, interest costs start to spike, deficits go up even faster than they are right now. People lose faith in the currency. That's the crack-up boom from the Austrian School of Economics. And they just dump dollars and euros and yen when they get them. They buy real stuff. The price of real stuff like gold and silver and farmland and oil wells goes through the roof. And the currencies just fall into disuse, basically. They are just given up on.
In a recent interview, John Rubino says that in the near term, gold and silver could face sharp declines, as seen in 2008 and 2020, when precious metals dropped alongside equities during market crashes. This makes cautious buying or profit-taking prudent. A longer-term bearish scenario involves choosing a 1930s-style deflationary depression, allowing debt defaults to protect the dollar's value and financial system integrity. Post-crisis, a stable balance sheet could enable future growth, similar to the mid-20th century recovery. Moreover, John Rubino predicts that if gold's long-term potential is $10,000 an ounce, current prices around $2,700 or even $3,000 seem reasonable. While a short-term recession could temporarily push prices down, aggressive Fed easing would likely drive them back up. With a clear path to significant gains, many investors see today's prices as a substantial buying opportunity despite potential short-term volatility. Now, let's get back to the interview.
Look what gold and silver did in 2008 and in 2020 when we had really sharp stock market bear markets, really sharp corrections in stocks. Precious metals got sucked down with equities in both of those cases and went down, 30, 40% or more in the case of silver. And that's a very real, I would call that a probability rather than just a possibility. So that's kind of a bear case for precious metals. You can make the case that you at least want to buy very cautiously now and maybe even take some profits here in the expectation that you can get back in at that V bottom, okay? The longer term bear case is less likely but still possible, and that is that when we come to the crossroads of hyperinflating or going back to a 1930s style deflationary depression, we choose the 1930s, and decide, okay, we're just going to let this debt be wiped out via default. And in that way, we're going to, protect the integrity of the financial system and protect the value of the dollar. And then, once we hit bottom and we're no longer deeply indebted, then we'll do what we did in the 1950s and 40s and 60s and 70s. We'll grow because we have a relatively stable balance sheet. That's highly unlikely. $10,000 an ounce is the end price for gold in that process. Then all of a sudden, $2,700 an ounce doesn't look crazy expensive. It feels like a good price considering where we've been. But if you look at where we're going, People who bought at $3,000 an ounce are going to be very happy when gold is $10,000 an ounce. So, that's the gold story in a nutshell, and it's very positive with some squiggles. There could be a recession that smashes gold down for a few months, but then the follow-on to that will be aggressive Fed easing, which will send gold back up towards 10,000. So, if your only risk is a short-term V bottom correction, and your ultimate price, which is very easy to justify, is 3 or 4 times today's price, then it's easy to see how people can justify adding gold at today's prices.
Gold's long-term outlook suggests substantial upside potential, making it an attractive asset even at elevated levels. The broader economic environment and central bank policies favor a bullish trajectory for precious metals. How might investors best position themselves to maximize gold's potential long-term gains? What factors could delay or derail the expected rise in gold prices? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.